In this update, we're going to provide a quick overview on what's been happening in investment markets the past few weeks, as well as look at a few stocks that we believe represent good value and have been buying lately. For the month of January, share markets around the world have fallen due to a combination of three things: low investor confidence in China's economy, declining US corporate profitability, and of course, falling oil prices. In the US, the Dow Jones was down 8.2%, whilst in China, the Shanghai Composite Index was down 22.6%, and in Australia, the ASX was down 5.5%. In early January, the Chinese government allowed its currency to depreciate by 2% against the US dollar to 5-year lows in a bid to support Chinese exporters. As China grew by only 6.9% in 2015, its slowest rate in 25 years, concerns that expected Chinese growth will be even slower is weighing heavily on markets as China tries to transition from a primarily export-based economy to a consumption-driven one. China accounts for almost 80% of Australian export growth, and due to the close ties between the two countries, problems in China directly affect Australia. This has been illustrated by the steep decline in energy and resource prices over the past 12 months. BHP has fallen by 48% and Rio Tinto by 30%. Oil prices have fallen by 55% over the past 12 months and currently trading at $27 US per barrel. Weak energy and resource prices indicate soft global demand and thus slowing global growth, which has weighed upon markets. In the first 2 weeks of February, markets have continued to struggle on the same fears of slowing Chinese growth, falling oil prices, and nervousness about the US financial sector. Share markets tend to overreact to news and either go up too much or buy down by too much. With the recent falls, we believe there is merit in considering further investment into blue chip Australian shares. We will now cover three of them that we're looking at the moment: Woolworths, NAB and ANZ. Each stock looks attractive with their current prices and should be able to maintain their current high dividend. Looking at Woolworths, the Woolworths share price has been flat following the recent announcement to close their fledgling hardware stores, Masters. Its share price fell by 23% over the past year, with the banks, ANZ and NAB, have fallen by 25% and 31% from their 2015 highs. With close ties to Asia, ANZ faces greater exposure to Asia's slower economic growth, but despite this, profits from their Asian retail bank were up 11% last year. NAB, on the other hand, after years of bad performance, have decided to offload its UK subsidiary, Clydesdale and Yorkshire Banking, to the public markets. In terms of dividends, Woolworths pays a healthy grossed up dividend of 6.5%, whilst ANZ is at 10.8% and NAB at 11%. This is in contrast to the other big four banks, Commonwealth Bank and Westpac, which pay 7.7% and 8.7% grossed up dividends respectively. Even in the face of a slowing Australian property market and potentially losses on banking loan books, the big four banks have strong balance sheets and are governed by strict capital requirements from the government, and thus should be able to maintain their current dividend rates as they did throughout the global financial crisis. ANZ, for example, have a provision of $900 million for bad debts, so we're not too concerned about a property market slowdown as the banks have prepared for this in advance. If you would like to discuss the economic outlook or any other investments in more detail, please feel free to contact us via phone or email. We would love to hear from you. From James Gerard and the team at financialadvisor.com.au, thanks for watching.